You want to see something absolutely hilarious, and by hilarious I mean perfectly illustrative of how broken precious metals markets actually are? Let me tell you about what happens when COMEX raises silver margin requirements, because this pattern has played out multiple times over the past few years, and every single time the exact same thing happens. Paper prices crash, physical premiums increase. Mainstream media declares silver bubble burst. Physical buyers say, "Oh, cool, a sale," and keep accumulating. And retail investors who don't understand the difference between paper and physical markets get absolutely wrecked. So let's walk through how this works using actual historical examples that are completely verifiable, because I'm not going to speculate about what might happen or what could happen. I'm going to show you what has happened multiple times with publicly available data, and then you can decide whether the pattern is likely to repeat. Spoiler alert, it always repeats. Let me start with March 2020. COVID hits, markets panic, everything's crashing. Silver drops from $18 to $12 in 3 weeks, 33% decline. And what happened to physical silver premiums during this crash? They exploded. American silver eagles, which normally trade at 2 to 3 above spot, were suddenly selling for 8 to 10 above spot. Generic silver rounds, normally $1 to $2 premium, jumped to 5 to 7 premium. You could watch spot price on your screen showing $12 per ounce and simultaneously watch dealers selling eagles for 20 to 22. The spot price said silver was worth $12. The physical market said silver was worth $20. A 67% premium over spot, not because dealers were being greedy, but because that's what it took to actually get physical metal. Supply chains were disrupted, mints were shut down or operating at reduced capacity. Refineries couldn't move metal because planes weren't flying, and retail buyers, seeing the stock market crash, wanted physical silver, lots of it. So demand spiked while supply contracted, and premiums exploded. This is documented fact. You can verify it by looking at dealer price history from March 2020. Wayback Machine has archived pages. Dealer forums from that period discuss the premiums extensively. It happened, undeniably. The paper market showed $12. The physical market charged $20 for eagles. Now here's what makes it interesting. About 6 weeks later, by May 2020, spot silver had recovered to 15 or 16. But physical premiums were still $6 to $8 over spot. So eagles were selling for 21 to 24. The spot price had increased 25 to 33%, but the actual price buyers paid barely changed, from $22 in March to 21 to 24 in May. The physical market just stayed where it was, while the paper market crashed and recovered. The physical market shrugged and said, yeah, we're still at 20 plus, because that's what metal actually costs when you want delivery. Fast forward to February 2021. The Wall Street bet silver squeeze. Reddit decides silver is the next GameStop. Massive publicity. Retail investors flood into silver. Spot price spikes from $25 to $30 in 3 days. And what happened to premiums? They exploded again. American silver eagles, which had normalized back to 3 to 4 premiums, suddenly jumped to 10, 13 premiums. You could see spot at $30 on your screen, and dealers selling eagles for $40, $43, a 33, 43% premium. For weeks, not days, weeks. The US Mint couldn't keep up with demand, dealers were on allocation, delivery times extended to 4 to 6 weeks, and premiums stayed elevated at $10, $13 for over a month. This is documented, verifiable. Check dealer price histories from February, March 2021. The premiums were massive, and here's what happened next. By April 2021, the Reddit frenzy had died down. Spot price had pulled back to $25, $26, but premiums were still $8, $10, so eagles were still selling for $33, $36. The spot price had declined $13, 17% from the peak, but the actual price buyers paid only declined about 15 to 20%. The physical market declined less than the paper market. Again, same pattern as 2020. Paper crashes or corrects. Physical barely moves because physical reflects actual supply and demand. Paper reflects leverage and speculation. Now let me show you the mechanism that causes this. CME margin requirements. The Chicago Mercantile Exchange, which operates COMEX futures, sets margin requirements for all futures contracts. Margin is the deposit you need to hold a futures position. For silver, it varies based on volatility and exchange discretion. In calm markets, margin requirements might be $8,000, $10,000 per contract. Each contract represents 5,000 ounces. So at $25 silver, that's $125,000 notional value per contract. $10,000 margin on $125,000 value. That's 8% margin. High leverage. You control $125,000 of silver with $10,000. But when volatility increases, the CME raises margin requirements to protect the clearing system, to reduce leverage, to force speculative excess out of the market. In March 2020, during COVID, CME raised silver margins from $8,150 to $14,000, a 69.7% increase in one day. You can verify this on CME's website. They publish all margin requirement changes, archived going back years. March 16, 2020, margins increased from $8,250 to $14,000. What happened to silver prices after that announcement? They crashed from $15 to $12 in the following days. Because traders holding maximum leverage suddenly got margin calls, they didn't have enough equity to meet the new requirements, so they liquidated, sold positions, drove prices down, creating a feedback loop. Prices drop, triggering more margin calls, forcing more liquidation, driving prices lower, classic deleveraging cascade. But here's the kicker. Who got hurt by this? Only leveraged paper traders. People trading futures with maximum leverage. Speculators with thin account balances. Short-term momentum traders. Those people got liquidated. Forced to sell, took losses, got shaken out. Meanwhile, who didn't get hurt? People who owned physical silver. Buyers who purchased coins and bars outright. ETFs holding unlevered metal. Companies with physical inventory. Long-term investors. They looked at their silver sitting in their safe or vault and said, the spot price dropped. Cool. I still own the same amount of metal. No margin call, no forced liquidation, no panic, just holding metal through volatility. And here's what makes it beautiful. While the paper market was crashing due to margin calls, the physical market was tightening. Premiums were increasing because the fundamental supply-demand dynamics hadn't changed. Mints were still running at reduced capacity due to COVID. Supply chains were still disrupted. Retail buyers still wanted metal. So even though spot dropped from $15 to $12, Eagles were still selling for $20, $22. The crash was entirely a paper phenomenon. The physical market barely noticed. This pattern repeats every time there's a leverage-driven sell-off. September 2020. CME raised margins from $14,000 to $1,500. Silver dropped 8% in 2 days. Physical premiums increased from 4.5 to 6.7. August 2020, another margin increase from $14,000 to $19,250. Silver dropped 12% in a week. Physical premiums increased from 5 to 6 to 7 to 9. Every single time. Margin increase, paper crash, physical premiums increase. The pattern is so consistent it's almost boring. And yet, every single time, financial media treats it like some profound market signal. Silver rally over? Bubble bursts. Investors flee precious metals. Meanwhile, in the physical market, cool, spot dropped. Guess I'll pay $28 instead of $32 for Eagles. Thanks for the discount. The disconnect is absolute, and it reveals the fundamental truth about silver markets. There are two markets. The paper market, where leverage dominates, where futures and options and derivatives trade, where prices can move violently based on margin requirements and algorithmic trading and speculation, and the physical market, where actual metal changes hands, where premiums reflect actual supply and demand, where buyers need delivery, not cash settlement. These two markets are supposed to be connected. The theory is that arbitrage keeps them aligned. If paper silver trades at $25 and physical costs $30, traders should buy paper, take delivery, sell physical for $30, pocket $5 profit. And that arbitrage activity should push paper up or physical down until they converge. But here's the problem. Arbitrage doesn't work efficiently when physical supply is constrained, can't get delivery quickly. Premiums are volatile. The $5 gap might disappear before you can execute. Storage and logistics costs eat into profits. Counterparty risk exists. What if COMEX can't deliver, so the two markets can diverge significantly for extended periods? And when they diverge, it reveals which price is real. The physical price, because physical metal has to actually exist and change hands. Paper contracts can be created infinitely, backed by nothing, settled in cash, but physical metal is finite. Someone mined it, someone refined it, someone took delivery. It exists in a specific location at a specific time. That's real. The paper price is theoretical, the physical price is actual, and when they diverge, the physical price is telling you the truth about supply and demand. Let me show you this with actual data from COMEX warehouse stocks. COMEX publishes daily silver inventory data, completely public, available on CME Group's website. Two categories: registered, available for delivery against futures contracts; eligible, stored in COMEX vaults, but not available for delivery. Let's look at what happened to registered inventory during the March 2020 crash. March 1st, 2020, 92.3 million ounces registered March 16th, 2020, margin increase. 89.7 million ounces. March 31st, 2020, 87.1 million ounces. April 30th, 2020, 83.8 million ounces. Inventory declined by 8.5 million ounces from March to April, during a crash that saw prices drop from $18 to $12 and back to 15s. Inventory declined, not increased. When prices crash, you'd expect inventory to increase as sellers deliver metal to exchanges. The opposite happened. Inventory kept declining because the people taking delivery, industrial buyers, ETFs, institutional investors, didn't care about the paper crash. They wanted metal. And they kept taking delivery through the volatility, through the crash, through the margin increases. The physical demand was real and persistent. Only the paper price was volatile. Same pattern in February 2021 during the Reddit squeeze. February ver 2021, 72.4 million ounces. Registered February 28th, 2021, 68.1 million ounces. March 31st, 2021, 64.7 million ounces. Inventory declined by 7.7 million ounces during and after the squeeze, even as spot prices pulled back from $30 to $25. The physical market kept tightening, while the paper market corrected. This is the pattern. Leverage-driven sell-offs create paper price crashes, but physical fundamentals don't change, so inventory keeps declining, premiums keep increasing, delivery times keep extending, the physical market divorces from the paper market, and eventually, the gap becomes unsustainable, and the paper price has to adjust to meet physical reality, which is what happened in both 2020 and 2021. After the March 2020 crash to $12, silver rallied to $29 by August, a 142% gain in 5 months, because the physical market was screaming shortage even while paper was crashing. After the February 2021 squeeze and pullback to $25, silver rallied to $28 by May. Not as dramatic, but still a 12% gain, because physical demand remained strong even as speculative excess got flushed out. The pattern is consistent. Margin-driven crash, physical premiums increase, inventory declines, paper eventually rises to meet physical, every time without exception. Now let me show you why this matters for understanding current markets, because the same dynamics are in play right now. According to CME data, which is public, silver margin requirements have been increased multiple times in 2024-2025, starting from around $10,000, $11,000 per contract in early 2024. Currently at approximately $18,000, $20,000 per contract as of late 2025. That's an 80 to 90% increase in margin requirements over about 18 months. And what happened to prices during this period? Silver went from 22 to 24s in early 2024 to 75 plus by late 2025, a massive rally. But with multiple corrections and crashes along the way, every time margins increased, prices pulled back sharply for days or weeks, and every time physical premiums stayed elevated or increased. Shanghai Gold Exchange premiums, publicly available data on their website, have been trending higher throughout this period, from $1 to $2 premiums in early 2024, to $8 to $10 premiums by mid-2025, to $12 to $14 premiums by late 2025. Even during paper price corrections, the premiums keep trending higher, not lower. American Silver Eagle premiums from major dealers, early 2024, $3-4 over spot, mid-2025, $6-8 over spot, late 2025, $10-13 over spot. The trend is clear and verifiable. Check dealer websites archived in Wayback Machine. Check dealer forums where people post pricing discussions. Check numismatic publications that track premiums. The data is there. Physical premiums have been increasing throughout 2024-2025, even during paper price corrections. Because the physical market is tightening. China implemented export restrictions in October 2025. India followed with restrictions in December 2025. The Silver Institute reports 4 consecutive years of deficits. Above-ground stocks are declining. Solar panel demand is accelerating. Industrial consumption is growing. These are fundamental factors. They don't change because CME raises margin requirements. They don't reverse because leveraged traders get liquidated. They persist, and they drive the physical market, while the paper market bounces around based on leverage and speculation. So here's what you need to understand. When you see headlines about silver crashing or silver rally ending, look at what's actually happening in the physical market. Check Shanghai premiums, check retail dealer premiums in the US, check COMEX inventory trends, check ETF flows. Those are the fundamentals, not the paper price. The paper price is noise. Margin-driven volatility, algorithmic trading, leverage speculation. It moves violently in both directions based on factors that have nothing to do with supply and demand. But the physical market is signal. Premiums at $12 to $14 in Shanghai mean Chinese buyers think physical silver is worth $12 to $14 more than paper. Premiums at 10 to 13 in the US mean American buyers think physical silver is worth 10 to 13 more than paper. These buyers are voting with real money. They're not trading futures. They're buying metal, taking delivery, storing it, using it. That's real demand. And when real demand persists while paper prices crash due to margin increases, it tells you the crash is artificial. It tells you the physical market disagrees with the paper market. And historically, when paper and physical disagree, physical wins. Always. The March 2020 crash from $18 to $12 resolved with a rally to 29s. Physical was right. Paper was noise. The February 2021 pullback from $30 to $25 resolved with continued strength. Physical was right. Paper overreacted. The pattern repeats because the mechanism is always the same. Leverage creates volatility. Margin increases forced deleveraging. Deleveraging causes cascading sell-offs. Sell-offs shake out weak hands. Strong hands accumulate at discount prices. Physical premiums increase. Fundamentals persist. Eventually, paper adjusts to physical. We're watching this play out again right now. Whatever corrections or crashes you see in silver prices, check the physical market. If Shanghai premiums are increasing, physical market is getting tighter. If U.S. retail premiums are increasing, physical demand is strong. If COMEX inventory is declining, physical supply is being drawn down. If ETFs are seeing inflows, institutional demand persists. Those are the signals. Everything else is noise. And if you can't distinguish signal from noise, you'll keep getting shaken out at bottoms by leverage-driven crashes, while the strong hands keep accumulating. The crash isn't real. The crash is margin requirements forcing over-leveraged traders to liquidate. The real market, the physical market, barely notices. It just keeps tightening. Premiums keep rising, inventory keeps declining, demand keeps growing, supply keeps contracting. Those fundamentals drive the long-term trend. Margin increases create short-term volatility. Learn the difference, or keep losing money to people who understand it. Your choice. The data is public, the pattern is consistent, the mechanism is clear. Margin increase, paper crash, physical premiums rise, fundamentals persist. Paper eventually adjusts higher every single time without exception. In 2020, in 2021, throughout 2024, 2025, the pattern repeats because the structure hasn't changed. Leverage dominates paper markets. Physical markets reflect real supply and demand. And physical always wins eventually. Welcome to precious metals markets, where paper crashes, while physical premiums increase, where mainstream media declares rallies dead, while physical buyers say thanks for the discount, where weak hands panic sell. While strong hands accumulate, the game never changes. Only the players. Choose your side wisely, paper or physical, leverage or ownership, speculation or fundamentals. The pattern has shown you which wins every time.